Hello there. We've had some good news in the last couple of weeks with US inflation coming down. US inflation is now at 4% per annum, having been over 9% this time last year. So it's really good to see that coming down, and that means the Federal Reserve, the US central bank, now feels that they can put interest rate hikes on pause. They're not saying they're done hiking, but they're saying for now they're going to pause and wait to see what happens and see what more economic data they get out before they decide whether or not to do any other rate hikes. So that's pretty good if you're living in America, and it's generally quite positive for markets as well, both in the US and globally. Here in the UK though, things are a little bit different. We're recording this on Monday the 19th. But this week we're actually expecting to see the Bank of England put up interest rates a little bit further. What we've seen in the last couple of weeks is some more data here in the UK sort of showing more signs of inflation being a bit stickier and likely to hang around for longer. For example, we saw wage inflation increasing. Now it's worth bearing in mind that wages, although they're going up, are actually still going up slower than price inflation, so in real terms they're falling. But in nominal terms, those wage rises are increasing, and that just gives a bit more concern that the price rises we've seen might stick around a little bit longer. And just generally, the UK economy has been doing pretty well, and therefore that gives the Bank of England scope to put up interest rates further. And because people have started to believe that rates are going to go up again, that's already fed into the gilt market, where we've seen prices of gilts fall, which means the yield has gone up. And that has all sorts of knock-on effects. In particular, has a knock-on effect to mortgages, where we're now seeing the average 2-year fixed rate mortgage is now about 6% per annum. So if you're about to renew your mortgage, which maybe you might have previously been on a rate of less than 2% a year, and you're suddenly having to refinance at 6% a year, that can be quite painful. So we do think some of the effects of the rate hikes we've already seen are yet to actually be really felt in economic terms. So we do think the economy will have a bit of a downturn towards the end of the year. But how steep that is might depend on what the Bank of England does from here. If they carry on putting up rates, then they're in danger of pushing up things a little bit too far and perhaps causing a bit of a more severe downturn. So we're watching that very carefully. But because those gilt yields have gone up so much, if you lend money to the UK government by buying a gilt, you'll now get a yield of about 4.5% per annum for 10 years. That's quite a bit more than, for example, if you lent your money to the US government, where you'd only get 3.7% per annum. So actually what that means is that lots of investors have started looking at the UK gilt market and saying, actually, that looks pretty good value, and started buying gilts. Because even although you'll get that yield, you could also get a capital gain if interest rates don't go up as much as expected, or perhaps even if they end up being cut again. So people are starting to look at UK gilts and say, actually, they look pretty good value. We're wondering if people may start to do that in the stock market soon as well. As we covered in last month's The Pulse, some parts of the UK stock market look a lot cheaper than the kind of equivalent markets overseas. And in the written version of The Pulse this month, we look at a couple of examples where we look at a multinational company, for example, like Unilever, listed here in the UK, and compare it to a similar company listed overseas, such as Nestle. And we see that the UK company generally looks quite a lot cheaper. That's not great for the UK stock market. That's why the UK stock market has underperformed, because people are willing to pay more to buy an overseas company than they're willing to pay to buy a UK company at the moment. But it's also opportunity as well, because you can buy a great company at a cheaper price. So again, with people starting to look at the UK and say, well, we're willing to buy gilts, maybe they'll start to look at the stock markets too. So we think that's quite interesting. But what we've seen so far this year is it's actually the US market that again has started doing really, really well. They have done extremely well, mainly driven by the big tech stocks. In particular, anything that is exposed to artificial intelligence seems to have done very, very well. In fact, if you took sort of the big tech stocks out of the US market, it's hardly gone anywhere this year. All of the growth has come from those companies. And one example that I think is really telling at the moment is if we look at Nvidia. Now, Nvidia makes microchips, makes processors that historically have been used for gaming because they're pretty powerful. But they're also very, very good for running artificial intelligence. And when they announced their results a couple of months ago, what was interesting is that they actually saw revenues fall. So they reported a fall in revenues, but they said that over the next quarter, they're expecting their revenues to increase by over 60%, just from those increased sales for people wanting to run AI. So it'd be really, really interesting to watch that and see if that does actually come to fruition, if in reality they do manage to increase their revenues by that much. Because if not, then you could see that stock fall back if investors are a bit disappointed. So what have we been doing in the portfolios because of all this? Well, generally we've been reducing exposure to some of those US top tech stocks. After they've done so well, we've banked some gains and switched into some other parts of the market which look a little bit better value. And we've also been looking at bonds again, and as bond yields have gone up, we've decided they look better value and been buying some more of those. So we've been reacting to all these things in the portfolios. Will be interesting to see what information we get later in the week in terms of UK inflation and what the Bank of England does from here. But it will certainly be, that will be crucial for what investment returns are like for the rest of the year. So we'll be watching that carefully and as usual, ready to react if necessary. So thanks a lot. See you next time.